Welcome to the Happy Hour with Rob Warner, an hour of stimulating conversation adding value to your financial future. Rob brings helpful insights into many aspects of the mortgage and real estate industry. Now, here's your host, Rob Warner.
Happy Monday, ladies and gentlemen. Welcome to the Happy Hour. I'm Rob Warner with Guild Mortgage. Hope all of you had a wonderful weekend and a happy Monday. I'm excited to bring two wonderful guests on my show today. One of them is Kimberly Foss, president and founder of Empyrean Wealth Management, and Kate Tustin Klein, owner and broker of Capital Crown Real Estate. So here we go with a great show. Before we bring Kimberly on, I have just one little plug for a band out in Roseville called the Ariel Jean Band. As many of you might have heard my Memorial Day show, they were on it and they played live, and they're wonderful and they're up and coming and they're a family and they're talented, and they're going to be at the Opera House Saloon on 411 Lincoln Street, Roseville, this Saturday. They have a band before them, but their show will start about 9 p.m. It's a CD release party, so please show up and support them. Well, here we go. Our first guest, Kimberly Foss. Hey, Kimberly, how's it going today?
I'm good. Rob, how are you doing?
I'm doing excellent.
Great.
I'm happy to have you on my show. I know it was a big commitment for you to show up here, so I'm really glad that you made it here today.
Thank you for asking.
So tell me a little bit about yourself.
So I am a wealth manager. I've had my company for nearly 30 years. Yeah. I started out with a stockbroker at Merrill Lynch and quickly discovered that was not a world that I really loved. So I said I'm going to do it my way and kind of never looked back. And we really specialize in women in transition, which are divorced or have sold their companies or are widowed. And we have thriving retirees and then also family stewards.
Excellent. So tell me a little bit about your views of interest rates and where you think they might be headed right now.
Yeah, that's been a big topic of conversation for a long time. I mean, for the past almost 10 years, Rob, we've been in such a low interest rate environment. It's been very difficult for my thriving retirees to even garner any kind of an income. So I think moving forward with this new, say regime, whatever, with the new presidency, and basically what we're looking for, the feds are looking for, is to raise that interest rate level back to normalization. What's normalization? Around 3%. So what they're looking for is we've raised the rate 3 times this year. They're looking for one more rate raise, and then probably next year will be 3 times, and then the following year, 2019, to get us back to 3%.
Wow. Well, that's a lot of raises, huh? What?
Yeah, I don't know if that's going to happen. I because you have this other looming issue out there called our deficit, which when we get to a certain level, we need the revenue to, of course, if you raise interest rates, it's going to raise the cost of that debt as well. So I don't think we'll get to maybe that 3%. I think we're going to get somewhere in between.
Oh, okay. So what should investors do with regards to loans, credit cards, home equity lines of credit, all those things that are probably closely tied to the Fed rates?
Right. So the short-term rates are raising, right? So the long-term rates, which are the mortgage rates, are not as adjusting as quickly. So if you have a HELOC out there, like right now, I decided to go ahead and get a HELOC. So I'm going to lock that in. So if you have a HELOC or if you have credit cards out there, anything that's going to adjust on a short-term rates, you want to get those either paid off or lock them in right now. If you're looking even for if you're thinking about a home, I mean, that's not to say go out and buy a home, but if you are thinking, go in, lock that in now, because those rates are going to be low this is low. This is still low rate, so.
Oh, I know. I've been doing this for a while.
Yeah,
okay.
you guys.
I remember when 10%, I was up till 2 a.m. doing loans at 10% because we had the lowest rate in town.
That's
so
right.
Now,
That's right.
Everybody's stressed out if the rates hit 4 and 4 1/8.
Yeah, it's still cheap. It's really cheap money.
But the last couple Fed raises have not raised mortgage rates, any long-term rates.
But that's not going to last for a long time. If they continue to raise, it will affect long-term mortgages. So don't wait. Lock it in now.
All right, good advice.
Get your credit cards paid off too.
Yeah, credit cards are people are going to see substantial increases.
Yep.
Yeah, that's going to hurt that.
21%.
Oh, I love that. So what should investors do with regards to their portfolios and particularly or the fixed income side of those?
Right. So the other side of the coin, unfortunately, with this low interest rate environment, people who have been retired have been really it's been difficult to garner an income off of that off those rates. Now that we're raising those, that's a good thing, right? That they're going to be able to raise the interest rate and they'll get more off their income. However, what you want to do really is when interest rates rise, of course, the relationship of interest rates and the portfolio of the bond, when interest rates go up, the price of your bond will go down. And if you're in a mutual fund of bonds, that will go down temporarily because what's happening is they're going to get those lower yielding bonds out of the portfolio and get the higher yielding in. So eventually you'll catch up. But the longer that you go out, the more susceptibility you are to a downturn in the portfolio, the principal. So here's this formula. The formula is if you go up 1% in interest rates by feds, the duration, which is your average maturity of your bonds, that it will go down by that. So if you have the average maturity of 5 years, then your principal is going to go down by 5%. Does that make sense?
Okay, 5%.
Right. So you
the
want
1% an increase by the
right,
Fed.
and we have one more. We have one more hit. Right in September, they'll probably raise one more time. So that's going to be a year. That'll be 1%. So what you want to do is you want to shorten up those maturities, shorten up those durations, very, very short. Get 1 to 3, maybe at max 5 years in your portfolio, unless you're going to hold the bond to maturity. If you're going to hold the bond to maturity, you don't have to worry about anything.
Because it'll recover in the
Yep.
long run, right?
Yep, that's exactly.
Okay, so you just don't want people in a long-term investment, and then they're stuck with it, right? When it's
Right.
not making you any money for a while, right?
I'm telling the clients this is a transition year. These next couple of years are transition, so you want to protect that principal at all cost.
All right, good advice. That's something I didn't know. That's good advice.
Yep.
Okay, talk to me about this because I like to have something connected with real estate, which
Sure.
we have talked about already, but purchasing real estate in an IRA. I have a couple clients that have done that before. Not many people, and I don't know if a lot of people know about it. Can you talk about it?
Sure, you can do this. You can do it. In fact, it was back when I first started with Merrill Lynch. We used to buy real estate in IRAs, and they were in the forms of limited partnerships back then in the day, right? There's some rules in there, though. You can't buy mortgages. You can't buy anything that's leveraged because you think about it, your IRA is your safe haven for the retirement. So there are rules against that. You can't borrow against it. You can't buy leverage. You can't have leveraging. So you can buy it as long as it's real estate that is completely paid for. There's some other rules on there too that you can't work on the property yourself. You got to do it at arm's length transaction, meaning that if Kate and I were sisters, I couldn't buy the house for her in the IRA. So there's certain rules. So you got to be real careful. And you want to do something like with a self-directed IRA. So there's custodians out there that can do that. There's a list of rules that you definitely want to abide by because if you don't, then you will disqualify your IRA, and you don't want to do that.
So you have to pay cash for the property, though. You
Yep.
can't. Okay, you can't have a leveraged
No
property.
leverage in it.
Okay, that's
because if you
something-
think about it, it's for your retirement.
Right.
Then everybody would do that.
Oh, I
right?
know.
And then of course back in 2008, nobody would have any money in their retirements either. True story. I have a client that if he didn't have his pension in his IRA, he wouldn't have anything because he took everything and went into real estate, ended up losing it, and the only reason he was safe is because he had money into a pension and IRA.
Oh, okay.
There's rules to that,
All
and
right.
for good reason.
Yeah, I know an investor, very astute investor that buys several properties, and they have them all tied up in their IRA right now.
Which is fine, but remember, when you're 70 and a half years old, you have to start taking your RMD, which is your retirement minimum distribution, which means that money has to be, or there has to be money liquid in that IRA to distribute out, because that's when the government gets their pay, right?
Okay, this is where it gets tricky, huh?
Yeah, so for 40 years, you might be putting real estate and doing really, really well. And that's fine, but you have to remember that a portion of that has to be in, cash, because at 70 and a half, you have to start taking that money out because that's where the government now gets their tax. If you think about it, right? For 40 years, it hasn't been taxed. They want their tax before you die. That's why they have the required minimum distribution.
Okay, I like this topic. We have like 1 minute to
Okay.
break, and here's what I want you to do because I don't want to miss out on your contact info. Can you please tell the audience how to get a hold of you?
Oh, sure. It's Empyrean Wealth Management. So it's EmpyreanWealth.com, 916-786-7626. Can't remember any of that. KimberlyFoss.com. Just remember that. It'll get you there.
Foss, F-O-S-S.
Yeah, like floss, just take out the L.
Very good. So, yeah, okay. Well, we're going to head to a break, and we'll be back. Don't go anywhere, everybody.
Adding value to your financial future, it's the Happy Hour with Rob Warner.
So we can talk about that. stuck with us.
Welcome back to the Happy Hour. I'm Rob Warner with Guild Mortgage, and we're continuing with Kimberly Foss of Empyrean Wealth Management. She's an excellent resource for you folks on financial planning and such. We're not going to belabor this, but this purchasing property in an IRA during the break, what was the conversation about?
Well, it's a great topic. And my question to you was, when somebody sells an investment property, whether it be in an IRA or not, you were talking about the cash disbursements. So evidently it has to be a balanced portfolio so that those payouts can come through. Strategize is probably the right word.
You can do that, but you have to buy the property in the IRA, right? So it has to be in the IRA. So if you sell the property and there's a capital gains, you're scot-free. It's good. It's all good, right? You don't have any capital gains because it's in your IRA. But
That's
remember,
beautiful.
Yes, but wait. Don't speak too soon, because here's the thing. The idea of money coming out of your IRA back in the day when the IRS developed this back in the 70s was that you were ideally in a lower tax bracket, okay? When money comes out of your IRA, it doesn't come out as capital gains. It comes out as ordinary income, right? So even though you might have this huge capital gains on the real estate, and that's one of the benefits for buying real estate in an IRA, is that you don't get, and also the the depreciation on there as well.
So here's my key question is, there's a lot of people who hold real estate as an investment currently. Now, if they do a 1031 exchange, can they 1031 something that they currently own into their IRA, like purchase it from their IRA? Can they do something that way?
You can't 1031, you have to buy full real estate in, so you have to buy the whole cash in the IRA. So all the real estate in the IRA has got to be full cash. So
well, right, but on a 1031 tax exchange, you have to do for like-kind property, which is, physical property. So let's say I own a house on Oak Street, and I currently own it. I'm 50 years old, and I know that has gained a lot of money over the last several years. I've earned $100,000, but after capital gains, it's painful. We all know that. So I want to make sure that I maximize my money. Can I sell that? And then, I can't because I already have. All right.
You can't. Otherwise, everybody would do it.
It was a good idea. That would have been a great
But
idea.
you were talking it through.
This is good. So if you have questions on this, folks, call Kimberly Foss at 916-786-7626. We're going to go on to our next question because time flies on this show. What are your thoughts on the overall stock market? Okay, there's the big question for you.
That's a loaded question, Rob. I mean, that's huge. The market is up year to date about 8-9%, which is fine. I mean, I think the market, is the market every once in a while, is it fairly valued? Is it overvalued? Is there a bubble out there? Those are all good quality questions. And I don't know. Quite frankly, my crystal ball broke in 2008 and never got a new one because I think actually the government bought them all, right?
Okay.
So, but the bottom line is that, you still need to be invested in a diversified portfolio, cash, real estate, stocks, and bonds in that. And it's through your whole lifetime. So there are going to be times where the markets are up, real estate market is up, real estate market is down, vice versa. So that's why you want to have balance. But I think that if the current administration doesn't come through on some of their promises, such as getting the healthcare reformed, maybe bringing down corporate tax brackets this year, maybe work on individuals next year, if some of these come to fruition, I think it will keep the momentum going. And they'll be, because the bottom line is fundamentals. Do we have jobs? We just had an excellent job report last Friday. So yes, we do have jobs. There's a renewed spirit. I think you can probably attest to this, Kate, that there's this renewed spirit of optimism. So we need that administration to come through with those promises to keep that momentum going. And I think that will be a really good thing for the market. Is the market overvalued? I don't know. Fundamentally wise, the earnings are there. So we maybe a tad bit overvalued, but I think we still have a lot of room to go if we can continue with infrastructure reform, jobs keep going, and with getting the healthcare reformed and getting corporate taxes down. Good
information. How can investors and our listeners protect themselves from a potential bubble burst?
Yeah, don't get greedy. Just don't get greedy. That's what happened in 2008, right? Everybody, kind of got. In real estate was the big bubble there, right? And also 1999 tech bubble, big time there. So stay diversified.
Leverage yourself to be able to hold through a down market.
There you
and
go.
They're not down forever. I mean, we have incredible interest rates, so you're paying down your balance essentially. So if you can hold through a poor market, you're in great shape. It's when you have to sell that it's no good.
Well, and that's the point. To make sure the asset allocation that you have is commensurate with your ability to stay through these downturns in the market. So if you're 70 years old and you have 70% of your money in real estate or 70% of your money in the stock market, bad news. Not a good idea. Right? You need to be diversified. So, here's the rule on this too. This is just kind of a general rule. You take 100 minus your age, and that's your exposure to equities.
Oh, wow. Okay.
Okay.
Another good tip.
And real estate
That's
we put
handy.
in there
That's
as
good.
equities too.
Right.
Good tip. Okay. What is your investment philosophy on managing portfolios?
So we believe that. I mean, I don't believe in timing the market. I'm definitely an asset allocator, long-term investor. So we believe that there are 3 dimensions to the market that you want to be exposed to: large cap stocks, small cap stocks, and value stocks. And then there's a profitability factor as well. So we manage those dimensions in your portfolio to make sure that you can get exposure to all those returns. Those returns have been proven by Nobel Prize winning philosophy back in 2015. He just won the Nobel Prize. So this is not new stuff. It just makes sense. And 80% of your money you want to put in kind of steady and slow growth. Doesn't mean low growth, slow growth over time. And then just diversify your portfolio.
Very good. Very good. Good info. So how often should I rebalance or look at my investments?
The more that people look at their more investments, the more anxious they get. It's kind of like looking at Zillow, right? I just looked at my.
Oh boy.
Oh, yeah. Don't
I get
start.
those calls all the time.
We don't
Hi,
have an
sell
hour
my
to talk
house.
about
Zillow says this is what it's worth.
I know. I just looked at it today, literally on my house. I haven't since I bought it 3 years ago. But you get excited about that. But so don't. I tell my clients, if you have to once a quarter. But ideally, semi-annually and annually. We rebalance on a normal year. We would rebalance once a year. If there's a lot of volatility in the market, we'll rebalance more often. But it's always to get you back to what that allocation. So if I have a client that's 60 years old, it's a 40-60 portfolio, 40 bonds and 60 into stocks. We will rebalance that, make sure that they're, basically if they get 5% out of that allocation either way, we'll rebalance it back to a 40-60.
So you're doing that for your client?
Yes.
They don't really have to worry about that.
They don't, but I certainly bring them into the picture. They are, because it's their money. So it's like you're still responsible, Kate. You're still responsible, Rob, for whatever you guys are invested in. I'm the fiduciary. I'm doing it, but you still need to have your hand in it. It's not like set it and forget it, and I don't care.
All right. So you're bringing the client in when you're doing this every
Yeah.
6 months or
Well,
during a
talking to
volatile
them,
market.
right,
You're getting
right.
them on the phone and
It's
going,
better
hey.
to get them involved.
Very cool. Hey, I didn't have this as one of my questions,
Yeah.
but you got to go back and share about the very beginning of the show about women. Your
Women in transition.
yeah.
Yeah.
Can you just talk about that for just a
Sure. I
quick-
mean, there is a growing market, and fortunately, unfortunately, I'm not sure, but women are becoming much more active in the real estate market.
Absolutely.
As buying and holding real estate in apartment complexes,
Right.
right, and so in their own portfolios as well. And the thing is, here's the thing: women at one point in their life, 1/3 of their life, they'll be on their own, one way or another. They'll either be widowed or they'll be divorced or what have you. So it's really important.
It's incredibly important. I see this a lot. I'm up there in the Roseville area, so we have Lincoln Sensity, which is 55 and older. Women outlive men. And I get more calls than you would ever know of women who call me and say that my husband died, and they have really little idea of what their portfolio is going to do. I mean, women with a longevity, you look at them and you never know, but it's probably 20 years. I mean, if you're, 65 or something like that, we're living longer. And I think that that's an incredible resource for women. And I want to share that with some people that I talk to because it's a reality.
Well, and we need to empower them so they're not afraid, but that they're empowered for that. I know we used to throw that word around a lot, but it's really about education. Women need to be educated a little bit more. They need a little bit more hand-holding, but they're fine. But they're great investors. In fact, there's been time and time again, studies again, that women have outperformed portfolio performances than men, hands down, like 1% to 2%.
Okay, why? Give me the reason.
Strategy.
It's testosterone.
Oh,
It's testosterone.
Uh-oh.
I'm sorry.
Uh-oh, why did I open that one up?
Let me just tell you. No, men, that's how you're biologically designed. It is. But women also aren't as educated. We haven't been playing in this field for very long, so we're not as confident. So we'll take more of the slow and steady, where guys will definitely go out there and say, I'll take this risk or I'll do this. Because that's how you're built. It's not a bad thing. But in the long run, we're looking at 20 to 40 years of investing philosophy here, that you want to have that 80% of your nest egg right there, man or woman. You still want to have that 80% there when you hit 60 or 65, so that now can work for you. That's your paycheck now. So now that's your paycheck, and you can go out and play. And we're all living longer, so that means that money's got to last not just 20 years, guys. We're talking about 90. I got 3 clients right now that are over 95 years old, still drive to the appointments of my office. I mean,
wow.
2 of them are women, 1's a guy.
That's amazing.
Do they eat bacon? Just a question.
I don't know.
Come on.
I don't know. I haven't, what's the correlation with bacon?
Because it's delicious, and
Oh,
I was
okay,
just
there you
wondering
go.
if I could keep
boy,
on
here
eating
we
it
go.
into my older age.
Bacon and drinking, right? And a shot of whiskey every day.
So is there anything else you'd like to share with the audience? We have a couple minutes left, and anything important that you feel?
Well, I mean, I just think people should don't get scared. Don't start knee-jerking reaction when the markets do come back, because we've been in this bull market for almost 8 years. As the average bull market's 7 years. We're probably going to have a pullback, guys. So don't absolutely freak out. And here's the number one thing: when the markets go down, just even in 2008, okay, it went down by 38%. And if you had international, you were down almost 50. Okay, here's the thing: the markets have always come back and gone higher afterwards. So it's never gone down and stayed. And everybody feels like, oh my gosh, it's the end. This is the end. And I kind of felt that way in 2008 too. But here's the thing: we've always come back. We've been resilient, and the markets always come back. So just be prepared to be able to wade through, as Kate said. You've got to wade through those difficult times. And honestly, I was buying. I bought Google. And I remember it was March of 2009. It was like $274 a share. Had never split yet. It's up and split 4 times since then.
So that was a wise move.
Yeah, I mean, I would put everything in it, but I mean, it was in my kids' Roth IRAs for their for their college education. But yeah,
That's something else too. I've already started an IRA for my kids, and they're not yet 18. They're just starting to drive. And I think that's really critical. Are you seeing younger people starting to take control of their retirement and their future a little bit now?
Millennials definitely have.
Perfect.
Yeah.
Very cool. We got 1 minute left.
I like the Roth IRA. I mean, I did that with my son, who's 4, so I have my own business.
Right.
So he started working for me, emptying moist paper baskets,
Right. My kids
shredding.
do that too.
Yep. So you can do that legally. I pay his taxes, right? I put $5,000 into his Roth. And so, the kid's got, he's 12 and he's, over
my
80
kid's
grand
10
in his-
years.
Yeah,
Mhm.
yeah. And see, what the cool thing about that is you can take, not that I would advocate this, but you can take the principal out of that as long as you've had it for 5 years. Take the principal out. And for my daughter, it helped her. She went on to grad school.
College.
Yep.
That's
Okay,
why
we're
we did
coming
it.
up on a break. Kimberly Foss, your phone number 916-786-7626. It's been wonderful having you here.
Thanks, Rob. Thanks
We're
for the
taking a
invite.
break. Everybody stay with us.
Bringing helpful insights into many aspects of the mortgage and real estate industry, it's the Happy Hour with Rob Warner.
Welcome back, ladies and gentlemen, to the Happy Hour. I'm Rob Warner with Guild Mortgage, and we're now going to be joined by my second guest, Kate Tustin Klein, owner and broker of Capital Crown Real Estate. Kate, how's it going today?
It's going great. I'm glad to be here. I'm having a good time.
Yeah, it's really nice having you interjecting with the other guests. It's great when you can have, everybody kind of discussing things. I love that kind of
Well, to
forum.
have a money manager give you their full attention and ask your questions directly is fabulous. I think maybe people don't do that enough with the people who are managing their money. She's a wealth of knowledge as well.
I know. I was real honored to have her on the show because of her status. It's hard to
Right.
get her time. It's like, I thought it was really cool. So tell me a little bit something about yourself.
Well, I'm the broker owner of Capital Crown Real Estate. Our main office is in Rockland. We serve up to Nevada County, El Dorado, Sacramento, Placer. Been doing that for quite a while. I was a relocation from the Bay Area myself about 20 years ago. I'm an MBA, and I sell a lot of houses.
Yeah, I read something that you sold and closed a home every working day in multiple years. Now, how does that happen, huh? Can you tell me?
With a lot of help, that's for sure, and a lot of organization. I've been an REO broker for several years. I diversify what we do. traditional real estate. I do stuff for corporations. I'm currently a HUD local listing broker as well. So I list those. And during the peak, probably from '08, the majority of my business was real estate owned, which are foreclosure businesses. And I did a lot for Fannie Mae, Freddie Mac, Citi. At one time, I had over 100 listings active, I would say, and that's not even including what we had in the pipeline and what we had in escrow. So that's how that happens. You have good relationships with people that trust you to do their asset disposition.
And you don't get any sleep, right? You work 24/7, right?
Well, you try to get some sleep, but you wake up a lot in the middle of the night.
So the real estate market, in the Capital Corridor of Sacramento has been on the rise since roughly 2012. Do you see this trend continuing?
Well, the reality is what goes up must come down. We're typically on 10-year cycles, and if you go back to even when '06 started to shake it up a little bit, and you go back to '96, I think that's when I purchased my first home in Loomis, and we were in a market that was not strong, which was advantageous for me. So we've been on the rise since 2012, and it's going to change a bit. We have a couple influencing factors. One of them is we do really have a housing shortage. We have an increase in the population, but supply and demand always has to be commensurate with purchasing power. And I think she hit the nail on the head a little bit when she was talking about rising interest rates. They're so low. If you look at a upsy downsy chart, whatever, and you go back to even like early 1970, and we're talking about even in the 80s, like 16% interest rates. You're seeing these crazy amounts of money. And we've been flatlined for 4 or 5 years, really. And the reality is the feds have to make money. And when that all changes, it will create a significant difference in purchasing power, because I don't think that our incomes have really kept up with the growth rate in the housing. But we're high demand. As long as it's wagons east from the Bay Area, we're in a good situation.
Which was going to bring one of my other questions, because what's the influence of the migration of home buyers from the Bay Area having on the Sacramento, regional housing market?
Well, it's definitely creating a crunch here. Elk Grove, all of the suburban areas, the entire 80 corridor when you come out of the Bay Area. And that's great news. People are looking for a different lifestyle. I definitely relate to that. I remember it was 96. There was a sniper on 580. And I remember driving home and I thought to myself, I'm moving. I'm not doing this anymore. And it was, I kind of was looking for that suburban lifestyle. I was ready to change out. I didn't have any kids at the time. So we're seeing a lot of people doing that. But at some point they do acclimate. So they come here, they still have some ties to the Bay Area, and they're coming here because it's more economical and affordable. So we're getting people who are really fit the demographic of Sacramento. So I would like to think of it as more of the Sacramento demographic of the affordability, the housing and everything of that is really growing. And that influence is going to have a major push on how much housing we need to build.
Yeah, that's the operative word, housing being built. Right?
Right.
Because
it's an issue.
Right now, I'm seeing a lot of the cash buyers. I'm getting off topic maybe a little bit here, but it seems like a lot of the cash buyers are probably migrating from Bay Area or Southern Cal or somewhere. Are they or not?
They are, but here's this interesting dynamic that I think people underestimate. It was ollie Oxenfree in 08, 9, 10, 11. If I sat in a room with probably maybe 6 or 7 people locally, probably 4 of them lost a house at that time. And it was pretty brutal. I was an REO agent. That's not a very fun they see you coming, and people that I knew, and not judging the whole, like she was saying, in 08, we thought it was done. We thought that the currency wasn't even going to still exist. Mm-hmm. So it was pretty brutal, but people became alleviated from a lot of debt. Any sort of cash outs, credit cards, there was a mass bankruptcy going on. So we sort of had a clean slate that started. And I think that's a little bit different. The people who made it through very well. And a lot of them realized that they were opportunistic, good for them, in 2012, and went and purchased properties. And I did a little bit of that myself, never anything that I listed myself because it's not right. But we would do that, and they've switched it up, and they have a lot of cash to go out and buy. So I think that there's a lot more local cash than you would think.
Okay, that's always been a question in the back of my mind. I'd love to know, because it takes a lot
There's-
of time to
there's-
save $300,000, $400,000, and some of these
Yeah.
people.
Unless you're like a superstar.
I know.
You
So I'm like, okay,
mere
we're-
mortals,
So I
that's
still
difficult.
love to find out. I'd love to just talk to every agent that has a cash buyer, and just for my own peace of mind.
They switch. There's a lot of families that are helping their youth. People strategize for what they're going to give their kids as some sort of inheritance. And I think they're realizing now they can purchase a house, help their child purchase a house, and they have longevity. They have a physical asset. So it's a lot more of a choice of how they want to invest money that they've accumulated over the years. We're seeing a lot of parents helping and assisting the youth and their family purchasing houses.
Well, that's good to know. I'm glad to hear that a lot of it's local money.
It
'Cause
is.
One thing I feared was that we turned Sacramento upside down with cash coming from other regions.
We have a little bit, but you have to remember that people coming from the Bay Area significantly are leaving because they don't have average price in San Jose and at what it's crested over $1 million.
Probably
It's a
higher
lot
than
of-
that now, huh?
It's a lot of money. I mean, you to be a 1%er in California, you have to earn over $1 million a year. So to be able to, I mean, when you look at the math, to be able to afford a home that's $1 million, it's pretty significant. And that's a much smaller population in Sacramento. So the money is coming in, but it's not, I don't think Mark Zuckerberg's moving over anytime
Okay,
soon.
got it. Good. That's good to know because I talk about that a lot because it scares me sometimes.
Right.
So what is the main influencing factor, do you think, on the housing prices over the next 24 months?
It'll definitely be purchasing power because supply and demand, obviously, we have it. Sacramento's growing, but when the interest rates change a little bit, we're going to see people. I'm already seeing it in the mail, cash out, refis. People are starting to spend money. And I think that there probably wasn't a lot of obligations that were diversified. Car payment, people were just like, give me housing. And they had minimalized really after the recession. It's kind of like when your grandparents after the Great Depression, there'd be one half cracker left in the little thing and you'd go to throw it away and your grandmother would be like, what are you doing? So I think the recession woke us all up to be thrifty. People are becoming a little more comfortable. I think that's going to definitely influence it. And we had a lot of people come back into the market and there is there's a disparity between the rise in housing prices and the rise in salary. It's not there.
Oh, I know.
And it's people can't afford it.
I've always said if the incomes aren't going up, where does it stall out, right? It
Right.
has to somewhere stall out, doesn't it?
It does, and what we have is, if somebody's doing an FHA loan and they're coming in at 3.5%, that's a manageable. I remember when I first got into the market, we had to have 20% down, and that seemed like this enormous mountain to climb, and it really is, especially if you're a young person coming out of college. We have some other factors. People are coming out and they have huge college debt. That's a whole nother topic, but that's something that doesn't go away. They need a car, they need to purchase a house, and if they're coming in at 3.5%, if there's a hiccup in the road, they have an issue. If they have to sell a house, I always tell people just plan flat. Even if your best friend or your aunt's a realtor, they're going to give you some kind of a break. Reality is it's going to cost you 6 to 10% any time to sell a house. So if we have the market adjust and we have a dynamic where people have to move it out, I'll tell you, we have a significant amount of people who still don't have equity. And on a 30-year loan, it's going to take you a long time if the market flattens. And then you'll have organic default, meaning divorce, job loss, things like that. Before, I kind of called it atomic default, right? Everything exploded at the same time. It was like a bomb was dropped here. But now it will be a little bit more natural and I don't know. I think that interest rates and purchasing power are going to be very significant over the next 24 months. And if it doesn't go down, I really can't see it raising significantly. I don't know where the money's coming from.
Yeah. Yep. It's a bunch of unknowns, huh?
Right.
So we probably covered this already. I had a question I was going to ask about other influences locally impacting the cost of housing, but I think you've covered that, right?
Well, it's they always say that cranes are the canaries of how an economy is doing in a city. And if you look at all the cranes in Sacramento right now, it's beautiful. That they've been so proactive in Sacramento with arts, education. They've been very friendly to new builds, new building and businesses, the rail yards. It's so beautiful. We're at the confluence of the river. There's not a reason in the world that we should not be one of the great cities. Just to drive through Sacramento, it's a city of trees. It's gorgeous. However, not everybody can live in downtown, and the reality is things like West Roseville have not been annexed. And it's taken years, you know, the Amoroso project and different things that you watch that. And, you know, there probably needs to be a freeway between 70 and Highway 65. And we have so much red tape and so much bureaucracy that that's a problem. We're not going to be able to keep up with that. And if we do that, if we continue to put so many hurdles and so much cost because development is a for-profit business, we're not going to get what we need. But if we can maybe loosen that up, give opportunity, create jobs, businesses will come. I mean, I think it's the great gold rush in California. But the key is allowing those things to move forward and not making somebody spend 20 years to get a development approved.
There you go. Well, we're coming up on a break, so give out your contact info.
916-207-7889. Kate Tustin with Capital Crown Real Estate.
Hold on, folks. We'll be right back after this break.
Now, back to the happy hour with Rob Warner on Money 1055 and Money1055.biz.
Welcome back to the happy hour. I'm Rob Warner with Guild Mortgage, and we're back with our guest, Kate Tustin Klein. That's your full name, right?
It is. My professional name has been Kate Tustin for a long time, but evidently they decided that I should use my real last name, so that I got a couple years ago.
All right. Well, I always like to call folks by their right name, you know? But
right.
You go by both, right?
I do go by both.
So we already talked about what will happen if interest rates go up, right? I mean, that's going to hurt buying power because of, you know, if incomes aren't going up to make up the difference.
It hurts buying power, but I think that people who currently have a property should not worry about it. And some things that they can do to protect themselves is, you know, people buy things on payments. If you've got something at 3.5%, I mean, hallelujah for you. If you can do an assumable, we're going to start seeing people do wraparounds and all different kinds of things. You know, like FHAs, I think they're assumable, aren't they?
They're assumable. You have to qualify for them, you know, meaning that you can't just, like in the old days, you've been doing this a while, right? Where somebody just deeded the property over to their friend or neighbor, you know?
Right. But we'll see people get a little more creative if it comes up. But I think that's significant. People have to realize what the difference is. If interest rates go up by 1%, that can change $500 in a mortgage. And people live pretty close to the benchmark. $500 for a family that's in a $350,000 house can make a significant difference. And I think the other thing people should remember is even though you can buy the house, they wear out. Water heaters, 12 years, that's going to cost you $1,500. Different things like that. So I think that's probably something people should consider. But if you can keep that payment low, that's great. And if you can double those payments or take it down and build some equity, you're in great shape.
I always tell somebody, you know, to turn your loan into a bi-weekly. You know, if you have a $1,200 principal and interest payment, not tax and insurance, but just the principal and interest part.
Right.
Just take, you know, $100 of that every month, 1/12 of it, add it to your payment. That makes a 13th payment a year and knocks about, 6.5 or so years off the term of your loan. Right?
My husband and I, probably about 7 or 8 years ago, interest rates were good. And I said, hey, you know, we need to do a 15-year loan. He's like, oh, that's going to raise our payment by $1,000 a month. I'm like, okay, well, don't have a car payment. You know, we'll figure it out. This will be fine. And there was a little bit of pushback, not too much. But, you know, we're 7 or 8 years in this. And he's so happy.
So you did the 15.
Oh, my goodness. Yeah, we did. And so we're not spending a whole lot of interest because I hear the argument or the rationalization a lot where people are like, well, I save on my taxes if I pay interest. I'm like, that's such a good thought. But here's the deal. You're still giving the money away.
Yeah. I never could understand the part about paying a $1,500 mortgage payment to get a $300 or $400 a month tax write. You know, why not have the mortgage paid off and you know, have the extra what, 900 or
And that's kind
1100, you know?
of that's this old school thought process, because the market's been so hot, it's good, and Sacramento is still very relatively reasonable. So I get calls all the time, especially because I do REO. Everybody thinks that those homes are a real value, and they do offer people the opportunity to create sweat equity by buy low, revamping them, putting their back into it, and making these great profits. But what I see a lot is people financing them, and they talk about cash flow. And I'll hear people say, well, it cash flows at, like $400 or $500 a month. But I see that they've done a 30-year mortgage, and I think to myself, you must be Jack LaLanne, because I don't know how long you think you're going to live, or when you're going to sell this, or how many times you need to figure this out. But the reality is, after taxes and at 4 or 5, if you have to replace an AC or do some landscaping, and you haven't put in vacancy factor, to me, that's not enough. And I think if you're hedging out on 30 years and just kind of making it through, so many different things can happen. Unless that's your plan and you're qualified to do it, I think that there's better ways that you can probably make money. And I think that people really planning on owning their homes is pretty significant.
Yeah, and that, the part that people do not factor in, and this is something that I could wear myself out talking about, is unforeseen problems, that come
Right.
up, right? Roof, water heater, like you said.
A roof is $23,000 probably, unless you have a cousin, and he must really like you if it's going to be less than that. And that's pretty much it. That's probably a 30-year composition shingle if you shop it out on a reasonable, let's say it's a 1,800 square foot house. Those are significant amounts of money, and what ends up happening is if people don't have the cash on hand, they'll refi. Well, guess what? You've restarted your clock.
Oh, I know. I shouldn't say this over the air, but I talked myself out of a lot of loans just because
Right.
I tell people, you're already 4 or 5 years in a 30 year. You don't, why do you want to start again,
Well, and I mean, if they're going to move or something and it helps them with cash flow, that's a big deal. But I think the trend that I've seen recently is that people have lost the dream or the idea or the rationale of actually owning their home. And the reality is it's a great decision for a couple reasons. One is keep that tax base. 1% of $1 million is a significant amount of money to go to the tax man. So if you purchase something and you keep it over a long time and you can keep that low, that's great. It also stabilizes you when you go to retire. I mean, I see people coming out and taking 30-year mortgages and they're 60 years old, and I think, wow, you're an optimist. 30 years, I mean, not to be, rude, but it's a reality. And I kind of see our plan financially, which was, I don't want to have a house payment after 60. So I see people who are younger and I think, gosh, go in there, really try to gain some traction. And then I hear people say, well, I'll buy small, I'll move up, and then we'll sell again and go down. Well, if you're spending, 6 to 10% every time that you do that, you have to factor all those things in. And then there's just life that happens. Like you said, surprises.
Well, you're full of wealth and of knowledge here, which is really good because people need a counselor. I call it a counselor, not just
Right.
a realtor, but a real estate advisor, right? That gives them more information about this stuff.
A lot of people get their information off of, I hate to say it, but somebody trying to sell them something. Here's the reality. I sell a lot of real estate. I'm going to. If I treat you well, you're going to call me. It'll be just fine. I don't have to sell you something that you don't need, so you come to me in crisis, and financial crisis, we saw it during 2008. It was horrible. I mean, firsthand as an REO agent, I was the first contact, and I would tell people, hey, by the way, your home has been foreclosed. You need to move. I'm going to offer you some relocation assistance, but I can't tell you how many times I cancel people who were ready to end their lives. Oh. Over just not having a house. And I would tell them, and here I am for the bank trying to sell these houses. And I would just tell them, it's not worth it. This is happening to everybody. It's a house. Do what you have to do. This is, and it just really destroyed people. So to see people take on financial debt that is going to sacrifice the happiness in the rest of their life, I think is a terrible decision. And I don't advocate it. It's not my decision, it's theirs to make, but I will definitely pipe up and say, I think paying 50% of your salary towards your mortgage is probably not the best idea.
Good for you. I knew I was going to like you just when we were talking before you came in here. No, because I'm that way too. I will tell somebody a straight up truth. Naturally, if they want to go through with it, I work for them. I'm going to do it, but I'm going to try to give them wise counsel. One thing that scares me now, and you'll probably agree, is a lot of people are panicking, thinking they'll never be able to buy a house if they don't buy it right now. So they're buying something that might need that roof in a year Or two, are they really considering where the money is coming from for that? I don't know.
I'll tell you because, essentially it's a seller's market right now, and that's great. Unfortunately, I'm seeing a little too much agent in the process where they're trying to leverage we were just working on something and we had 7 days to complete our inspections for a home. That was $750,000. 7 days to decide whether you're going to pay take a minute. And the buyers are so desperate, they think that something's not going to come. So my best advice to people is take a deep breath. Don't be pressured. Do what's right for you, because making a bad decision is always expensive. That goes with marriage, having kids, picking a job. Give yourself a minute to do that. And I think that that's probably pretty critical. Even though it's a seller's market, if you find something that's fantastic, pay for it because somebody else will. But I'm seeing people make a lot of concessions that I know are probably, like, oh, well, we'll just redo the kitchen. And I always pipe up and say, oh, that's awesome, but I'm just going to let you know that's like $30,000 to $50,000 because you're a Pinterester and you have all these great ideas.
I will admit publicly that at one time in my life when I was young and dumb, I bought a house that the realtor advised me not to go into because of the amount of work that needed to be done. And I just went, I can, in the long run, I guess none of the stuff ever got done that I really planned to do.
Right.
You see what I mean? She was trying to tell me, buy the house that already has all that stuff
right.
done.
Because if you're buying on payments, you don't have a large down payment, the odds that you have $20,000 to $30,000 to toss it in, and I see people go, I'm going to go to Home Depot, which is great. Home Depot's great. It's a great resource, but you still have to buy the product, and it's pricey. And I inflation is. They're not really talking about it a whole lot, but I'll tell you what, the interest rates are going up because that's a hedge against inflation. That's how they slow it from going crazy and how they keep it from going too low and completely devaluing the dollar. But we're definitely seeing inflation, and I'm really funny. I buy organic milk. I know that doesn't seem like a big deal, but that should be like gold or platinum. Honestly, I think it's the same price. And I know what that price is because it's almost $8 a gallon. I could tell everything about inflation of whether I go in and it's $8.99 or $7.52.
Oh, I'm with you. So we got a couple minutes left. So what do people need to look for when they're hiring a real estate agent?
Oh boy, somebody who's not going to tell you what you want to hear and who is attentive. And I see people go, what was the term I heard? The sparkle. They go for the sparkle. Go for the smarts. There's a lot of glad handers and big smilers, and they're probably good agents. But the reality is there's a lot of people ready to tell you what you want to hear. And you're best advised to get somebody who's going to tell you what you need to hear. You can still make those decisions, but you need to be able to make an informed decision. So experience at this point in time, we have a lot of people who've been coming back to the market, who've been doing it now for a couple years. I've seen, I started in real estate working for my mother in '89. So get somebody who knows what the market can do.
We'll give you your information on it again. We're coming on a break so quick.
Kate Tustin Klein, 916-207-7889, or find me at kate@capitalcrown.com.
Give Kate a call, ladies and gentlemen. She knows her stuff. Have a great rest of the week, and we'll look forward to having you on listening to our show next Monday again. Take care.